Hi, can you hear me? So thank you for bearing with us. We will now move to the second part of the panel discussing the impact of rising private debt markets. It is our pleasure to have with us on stage Mr. Mathieu Chabran, the co-founder of Tikehau Capital, Mr. Joshua Friedman, co-founder, co-chairman, and co-CEO of Canyon Partners, and Mr. Roberto Hoornweg, co-head corporate and investment banking at Standard Chartered. Gentlemen, thank you very much for taking the time to be here with us. So we already had a conversation. I'm not sure if you were with us in the room. In the previous 20 minutes, we discussed the potential growth for the private credit space and the associated risk. Mr. Chabran, why don't I start with you to give us your point of view on that before we move on to more specific topics?
Sure. Well, thanks for having us. And since there was a part one of this discussion, I will maybe pick it on the credit secondaries, because I think our colleagues covered the emergence and the very strong and solid growth of the primary private debt market over the past 10, 15 years. And effectively, it seems that we've come to a time now where there is a huge opportunity to provide the liquidity that Glenn and Dan were talking about. And his comment about the leverage loan market, the perceived liquidity, the actual liquidity, and what's happening on the real private market. Well, I can tell you, we at Tikehau, we launched a secondary private credit practice a couple of years ago. And the couple of billion we've deployed was acquired at 96 cents a dollar. So a 14% discount, which effectively illustrates what is the illiquidity premium you need to get to provide the liquidity to this primary debt market. So after such a solid growth of the market, I'm expecting, similar to what we saw in the private equity space, by the way, and the venture space that other colleagues discussed earlier, I'm expecting this to grow, to provide liquidity to an illiquid asset class. This is what our clients, the investors, want to see. And from an allocation standpoint, the risk-reward, in my view, doesn't get better than that.
Mr. Friedman, I want to go back to the risks associated, especially that we were through a period of very high interest rates, which increased the rates of default. So are investors underestimating the risks in the system?
There are a lot of companies that can't survive the current interest rate environment, and if they refinance into it, they're going to have issues. I saw a B of A piece that said 80% of the companies rated below BB had this issue. I don't think it's quite that high. But I think that the private credit's a little different from looking at secondary markets and refinancings. Mostly first lien with a stretch that's made it larger. Generally speaking, where you have systematic risks that take place, it's when there are institutions that are doing the lending that are highly, highly leveraged and have a mismatch between their assets and their liabilities. That was what happened to Lehman Brothers. That's what happened to long-term capital management. That's what happened in the GFC to all of the commercial banks. And it's also what you saw earlier this year with SVB.
The small-sized banks or middle-sized banks.
They had long-duration assets. They had short-duration liabilities. And it wasn't well matched on top of a lot of leverage. The leverage implicit in the private credit market is tiny. It's maybe one turn of leverage in general, as opposed to multiples of that in the banking community. On top of it, bank deposits can leave, whereas the liabilities, if there are any at all in private credit funds, really are generally well matched. You look at something like CLOs, which are basically the predecessor to private credit, but with syndicated loans, and the default rate for the CLO entities themselves that buy bank debt are tiny. It's like measured in basis points. And that's in spite of 10x leverage. But that's because the assets and the liabilities are extremely well matched. But it's also a pretty careful curation of assets. But in private credit generally, it tends to be a little riskier debt than what we might traditionally think of as first liens, but so much lower leverage that the excess spread has offset it. The only other point I would add to that is, in the initial stages of the private credit market, when there was this very rapid accumulation of assets, there was so much cash that flowed that the spreads were much higher than they are now. So we have to be candid about that. The large cap unitranche lending was being done at 675 over, 650 over, and those same loans are being done today, maybe with fewer covenants, and they're being done at 450. So I think not to think that to think that you're being as well compensated as you were maybe 3 years ago in that part of the private credit market, I think would be inaccurate. I think it is riskier, but nothing close to the level of the type of systematic risk that you're inquiring about.
Mr. Hoornweg, from an investor's perspective, are there any specific risks that investors should be looking at when they approach this market?
Well, I think that when you look at what's happened in the markets and this ebullience in the equity markets and tight spreads in secondary markets, et cetera, it sort of clashes with what we're seeing in the macro environment where fiscal rectitude in Europe and the US has gone out the window. And therefore, giving money to manage to these experienced private credit managers is very attractive. So investors do like the asset class. The asset class will explode. We heard this morning in the plenary, there's so much debt that needs to come out. And I think to Josh's point, the asset liability thing is the main risk mitigant from what we've seen in the past to exit systemic risk. However, we are starting to see investors want to co-invest maybe more or have much more visibility on the deals. So transparency, covenants, pricing become far more relevant. So I think in the next few years, we'll see the whole private credit class become an asset class which is about idiosyncratic risk, rather than the beta of it, that large managers with expertise can just raise money and then place the money to wherever they want. So I think more scrutiny will happen, and then there's potentially regulatory risk. You know, the banks have largely been regulated out of holding debt for a long period of time due to the RWA heaviness on their balance sheets. And we'll see what happens in this sector if regulators start looking at it more tightly.
Mr. Chabran, let's talk from a policy perspective, but not only from a regulatory perspective, from a policy perspective. To what extent does the growing private credit market cause a challenge for central banks from a policy perspective, doing their job, not only on the regulatory side?
Well, I don't know if I can comment about the central banks, but from an asset manager standpoint, and to the risk of being not that popular, I think that the skin in the game should remain, you know, the paramount approach for any third-party asset management. In credit, maybe I could challenge what was being said earlier on the other panel when they say that banks were 10 times levered and private credit is 1 to 2 times levered, but you're levered on someone else's equity. You took third-party money in your fund, it might be effectively closed-end, you put some leverage on top of that, but as far as I know, you know, it's not the manager's capital in there. So what we saw in Europe, less so in the US, you know, after the GFC and some regulations coming in, the retention rule on CLO that lasted maybe 2 minutes and a half, you know, in the US. In Europe, you know, it stayed longer. I think that, you know, there might be, I think it's a good attitude to increase the skin in the game of any given manager side by side by their clients. Not only, you know, the clients, they like that. You're not making money with their money, but you're making money with your kids' money. And I also think that from a performance standpoint, that should incentivize you to be more disciplined in the risk underwriting.
Mr. Friedman, do you think that there are implications on how monetary policy works from the shift that is happening?
Well, it's very interesting. Obviously, inflation has a lot to do with base rates. We have a much more vertically sloped curve now, so the short rates off which loans are priced is lower, but longer rates are higher. And that can make bank loans in some fashion maybe less attractive than loans that take advantage of the upward slope of the curve. On the other hand, as rates move down or rates move up, you have different type of exposure on long-term fixed rate assets. I think people overstate the importance of monetary policy in some respects, because a lot of the problems that monetary policy is designed to address are problems that were generated in part not by monetary policy in the first place, but by fiscal policy. So wild amounts of overspending by governments and deficit spending that really has nothing to do with the Fed sowed some of the seeds of the inflation that we're seeing today. And a lot of the spending that's still taking place sows some of that seeds. But we look to the Fed to somehow control this problem that really wasn't of their own creation. Now, I'm not
You have a call, by the way, on who's going to be in the White House soon and whether the spending will continue at that rate.
Hard to outbet the betting markets on that. But I just think we look too hard at government policy. The one thing I would echo that we were talking about before is that when things get over-regulated, and in the case of banks, you've got retail investors with bank deposits, what happens is the costs of that regulation become very high, and eventually those markets shrink at the expense of other markets. For our entire careers, for all of us, we've watched the public markets shrink at the expense of private markets. We've seen it in private equity. We've seen the number of public companies shrink. And the same thing is happening today when banks have literally tens of thousands of regulators around their superstructure of loan origination and maintenance. And that's a hard cost base to overcome. So you've seen private markets take over. In the case of the private markets, the investors are very, very sophisticated. Not every single one, but generally the ones at the margin who drive the market are extremely thoughtful, extremely intelligent, and do extraordinary due diligence. So I think pressures to start to regulate the private credit market, you're going to have regulators who are a lot less sophisticated than the capital allocators who are doing their own policing of the market.
Mr. Hoornweg, you're smiling. Tell me what you're thinking.
Well, I mean, obviously as a bank, I feel the pain. Right? But I do think that regulation is inevitable. And I think there's some mitigating factors. The skin in the game is a fantastic mitigating factor, and it's similar to increasing Basel rules for bank capital. It's not that different philosophically. I think it definitely needs to come, and it's good for the end clients. It will reduce systemic risk even further, even though we all agree that systemic risk in this sector is far lower than what it was in the banking system 15 years ago. But something will give, especially if one risk is this continued search for yield, compression of spreads, covenant light, that then brings this whole less transparent asset class to be priced right on top of public markets. At that point where there's no value, that's when there's then potentially the impetus for bad behavior, not nefarious bad behavior, but just for something to go wrong.
Just to follow up from an investor's perspective, what frameworks do they need to have in order to properly assess risk versus return in that space?
Well, it's going to take a while for investors to have the same kind of credit analysis tools that the managers have, because there's a 20-year gap and there's a big skilled gap. But I think that it's all about transparency on the funds. And I think that there is a big learning game. I mean, to the point of the regulator skill gap, I think there's also an investor skill gap. So for it to become an asset class that is also held by retail, we could end up going with very different liability structures as well to make it more palatable. I think transparency and homogeneous set of documentation globally will be necessary.
Could I add a response to that one on the regulatory front?
Sure.
The regulators are often chasing yesterday's problem. And they're also chasing systematic problems and applying the same regulations to everybody.
Well, they're not as paid as you are, so.
Well, if you look at the real estate issues that came to light with the regional banks in the US, which had too much invested in illiquid loans, often in not such great assets. And then you had interest rates go up, so the value of the property went down, and now all of a sudden you had a stretched balance sheet. The result was a near prohibition on banks making real estate loans. And they did it through the mechanism of assessing unusually high capital charges on any real estate loans. The result is that private real estate loans are a phenomenal place to be. The loan to values are lower than they've ever been. The base values are lower because interest rates are higher. The coverage is higher. You don't have to stretch and do secondary office building in a lousy market. You can do primary residential in markets that have a shortage of housing and inflow of population. And you can't get a construction loan. And if you can, the capital charges for the bank are so high that they can't give you much of one. So this is a real issue today.
We have
just to add one thing, the shift of credit from systemically risky balance sheets, such as banks that have a fiduciary duty on depositors, to more matched liability structures, no matter what it might do on pricing, is a healthy thing for the economy overall. And that's the key point, the liability.
We have 3 minutes. Let's have a final round of forward-looking questions. Mr. Chabran, how do you see the market going forward? What changes or shifts do you foresee happening? And you mentioned skin in the game. How do successful private credit fund managers balance between delivering the higher rates of return and yet have a sensible approach to risk?
Well, first of all, I think there is a convergence between the public market and the private market. How should we define a leverage loan? Is it a public security? Is it a private, instrument? And as we said, that's the step one of what private credit has developed into. So I believe into this convergence. By the way, every week you're seeing some big announcements between banks and asset managers, and I think it's the first step of this convergence. And as far as balancing performance with effectively risk underwriting, I mean, the skin in the game is for me the step one. I don't think that credit is about trying to find the extra juice for the asset. Credit is about return of capital. And so starting with this main assumption, with a bit of skin in the game, pricing the illiquidity when there is some illiquidity, I think the asset class has a bright future.
Mr. Friedman, your outlook on that space, and I know you are not with overregulation, as you have said earlier, but how do we avoid the GCF, the previous failures in ethics, which have led us to previous catastrophes going forward?
It's not necessarily ethics, but you talked about aligned incentives. There's no question that the incentive for a lot of firms to create enterprise value for their own firms was to raise the largest funds as fast as humanly possible in the fat part of the market. And the result of that is that there's $500 billion of idle capital seeking large unitranche lending in acquisitions when acquisitions have slowed. And so pricing's gotten tighter, loan-to-value's gotten higher, and covenants have gotten a bit worse. So risk return's a little less good for the investor. Not to the point where it's catastrophic, but those are the incentives, and you should be aware of those. What we all try to do is we try to find the white spaces in the market, the places that aren't quite as crowded, that haven't been oriented around those types of incentives. So maybe that's in Europe, where things are usually a few years behind what might be going on in the US, and relationships and so forth make things just a little less commodity driven, although the economy is not maybe quite as robust. Maybe that's in structured products and asset backs, which are maybe a little more complex and maybe not quite as scalable. So we do things to announce these sourcing arrangements of the sort that Mathieu just described. So we're all looking for those white places on the board, and obviously incentives drive capital in one place or another, just as they do in private equity or in any asset class. I think investors are aware of that, and those things are very much self-correcting.
Mr. Hoornweg, we will end this session with you. What should be done? What are the lessons learned, you think, from previous credits, previous crises, so that we continue on a sustainable path going forward without repeating the mistakes of the past?
I think the lessons are about concentration.
We need the microphone on last answer, please. Yes.
I think the lessons are about concentration risk, as has been said, diversification, and then also, as was mentioned, the partnerships, right? At Standard Chartered, we've been in this game for a while through partnerships, which we have not made public, but as you've said, we've seen large public trades happening. And I think if you have all sides of the banking ecosystem, whether it's a private credit experts that take the risk or the banks that originate, there's jigsaw puzzles that they can work together. That gets trades done, that gets the assets to the investors, and again, to beat on a dead horse, keeping that asset and liability structure aligned is the best way to not have any systemic risk as the ones we've seen in the past.
Mr. Chabran, Mr. Friedman, Mr. Hoornweg, thank you very much for this very interesting discussion, and thank you also to our panelists in the previous panel. Thanks a lot.